Week 7 weekend update video. This is Professor Hassey. It's Saturday, May 21st. Is it really May 21st? Amazing how time flies. And today we're just finishing up week number 7 work. We're going to review assignment number 3. The solutions and grades have been posted to Blackboard. Also, we're going to talk about key points from chapter 16, debt, and chapter 17, dividends, which you'll see on your final examination this next week. Speaking of that examination, I will be posting that Sunday evening at 6 o'clock. The final examination will be posted Sunday evening at 6 o'clock, and it is due 1 week later on Sunday, May 29th at midnight. Once you post your final examination work and your course evaluations are completed, the grades of this course will be posted to Blackboard on June 2nd, and we can wrap up your Business 330 Corporate Finance studies for this spring. Congratulations. You have assignment number 4, which is basically assignment 3, where it's same as assignment 3, except for a couple different challenges, and I indicated those in my beginning of the week video on a Monday. So let's take a look at assignment number 3. Okay, this is the solution file that's posted in Blackboard, which could probably help some of you with assignment number 4, but most of us did very well on this. A couple of key areas that I'm going to talk about in this review of assignment 3. This is a capital budget project with a depreciable life of 5 years, an investment in year 0 of $750,000, generating 40,000 units of sales every year for the 5 years at a revenue of $40 per unit selling price, generating, as you can see, $1.6 million every year for 5 years. The associated variable and fixed cost, the variable costs, which are per unit at $30 a unit, times the 40,000 is $1.2 million every year. The fixed cost are $175,000 a year, and the depreciation is $150,000 a year for 5 years, fully depreciating the asset over its depreciable life. Tax rate of 22% on that earnings before taxes of $75,000 gives us $58,500 of net accounting income per year for the 5 years. And then we get into determining the net cash flow of years 0 through 5. First of all, the salvage value, $25,000 received as disposal of the asset at the end of the 5th year. But since we've fully depreciated the asset over this life, that $25,000 now is considered a gain on the disposal of the asset, which we have to pay a tax on of 22%. So taking 22% of $25,000, we end up with $19,500 as cash flow from the disposal of the asset in year 5. The depreciation expense of $150,000 is added back in to the project cash flow since it is not a non-cash expense. And then we have working capital, 10% of next year's sales. So in year 0, 10% of year 1 sales is $160,000 negative cash to fund the working capital requirements of this project. Since the income numbers do not change, there's no variation in sales throughout the years. Thus, the next time that the working capital is hit is in year 5, when the $160,000 is added back. Excuse me. I'm sorry. $160,000 is added back into the project. Since there's no more revenue going forward after year 5, that working capital requirement is no longer needed. Thus, it is added back, netting 0 as far as the total project, years 0 through 5, but showing the disbursement of cash to fund working capital in year 0, and the cash coming back in as the working capital requirement is no longer needed after the final year. So thus we're generating $910,000 of cash negativity in year 0, the year of the investment, $208,500 years 1 through 4, and $388,000 at the end of year 5. Some of us forgot to include the salvage value in your arithmetic for the net cash flow. It's 58.5 plus 19.5 plus 150, 160, 388. So we have a total cash flow being generated of $1,222,000. That $1,222,000 over the 5 years is discounted back at our project WACC is 9%. And there's the calculation in the cell, taking the NPV at 9% from years 1 through 5. It ends up to be $927,655 of discounted cash flow in the year of the investment. Thus, our net present value is the difference between that $927,655 and the $910,000 investment. We're generating $17,655 in dollars of net value return on this investment. That is 9.68% in a percentage return. Using the IRR function spread out over years 0 through 5, we get 9.68%. The profitability ratio of the discounted cash flow to the investment is 1.02. And the payback is 1, 2, 3, 4, and 20% of year 5, 4.2 years to pay it back. All the calculations are in each cell. And I urge some of you, if you want to do better on assignment 4, which is basically the same project, except it's 10 years in life, you have to calculate the WACC, and there's inflation involved in some of the key variables as we explained in our Monday video. I consider this a go investment. Some of you considered no go, and you don't take any points off. As long as you tell me your interpretation, that is fine. You're going to have to do the same thing in assignment number 4, due tomorrow evening. And there are extensions available if you need it. But you need to do a little bit more elaborate interpretation of your recommendation in assignment 4. So that's all worth 100 points. That analysis, as you see in front of you, is worth 100 points. Then we had 3 extra credit questions worth an additional 20 points. So whatever you did on your capital budget analysis, whatever you received, which is indicated on the sheet, add whatever you received in extra credit. The first question was true and false, worth 5 points. Second question was fixed and variable cost determinations. Here are the calculations, worth 10 points. And question number 3 was a break-even analysis. Tell me how many units and in dollars, what is the break-even point for this company given in the example? 5,000 units break-even, 500,000 units, $500,000, the break-even amount in dollars. You did all those correctly, you got an additional 20 points. So if you did all your work correctly, that's 120 points added to assignment number 3. Pretty good. Some of you with that extra credit was able to get a very good grade on this, and it helped your grade point average heading into the last 2 grades coming up. So that's assignment 3. Good job. And again, you use this and modify it a little bit for assignment 4. Well, now that we've completed our capital budget analysis, which is a very important part of our second half of our course with assignment number 4, now we finish up these next 2 weeks with some additional study and detail of some other issues involving financial management. And the good part of chapter 16 is you pretty well know most of this already, the capital structure of a company, the assets, the liabilities, and equity of a business. The management of that capital structure determines the value of a company. If you have assets, the market value of those assets are what is called the market value of the company. Taking away the debt of that company determines the value of the firm to the stockholders, to the equity holders of the company. Capital structure is how the business is funded, and that changes from quarter to quarter in a company. And one of the key aspects of future value determination of any company, small, large, not-for-profit, or for-profit, is to balance and make sure you understand how you're funding the growth and the assets of your business. Very important. One of the key things in the financial management of a company is to always, as I just said, understand that mix of debt and equity to finance your business. And when a company needs to create additional value or they're under some stress due to economic conditions, many times they have to restructure this debt and equity position within a company, sell off assets to pay off long-term debt, purchase more assets to create more return, more profit, more cash flow. Restructuring is an ongoing exercise in financial management, finding the optimal level where debt and equity provide the greatest value for your company. And as you know from our studies the prior weeks, and at what you're doing in assignment number 4, you're determining the cost of that capital structure and your weighted average cost of capital. The cost of debt, less the tax advantage you get from it. The cost of issuing equity, what the investors demand as a return from your company in relationship to the risk in the market, the risk in the risk-free rate, and your own company's risk. How does that equate to the cost of equity? The capital asset pricing model is one of the main determinants of that amount. You're working on that in assignment number 4. So the management of this capital structure to achieve greater value in your business is one of the sole purposes of how you maximize the value of a company in financial management. One of the most interesting things about this balancing and this management of capital structure, and it's many business owners and investors find this quite surprising, but it's true, and it's highlighted on this chart taken from your textbook. If you're financed by all equity, in other words, stock is your main, you're totally financing your assets by the issuance of equity. That produces a less of an earnings per share or a less profit than if you put in a little debt into that mixture, as highlighted here. Notice the operating income when you're financed by debt and equity is a little bit about 125,000. If I'm financed entirely by debt, that reduces. And the reason for that is because debt is expensive. The most expensive form of finance, of cost of raising capital is debt. It's not debt, is equity, excuse me. Equity is the most expensive. Why? Because it's in relationship to the risk in the market. If the market in risk goes up as it's doing today, equity becomes more expensive. Why do you think the stock market is having such a difficult time the last week or so? Because interest rates are going up, inflation is going up. Investors know if those costs go up for stock, the company's going to probably make less money. Maybe I should get rid of my equity positions. When interest rates are low, like it was for the last 10 years before the pandemic, when interest rates and borrowing was cheap, more companies borrowed money because it was cheap capital. Why issue stock and have to pay 9% return when you can issue debt at 3 or 4%? But now that's beginning to change with inflation. It's now beginning to change. And as a financial manager, understanding that basic concept, cheaper money, debt financing, more expensive money, you're caught between a rock and a hard place. Your risk will go up. Your expenses are going up as raising capital. A key part of financial management. But there is a risk to financing by the borrowing of money. Yes, the cost is cheaper, but there's additional risk involved in borrowing money, as a lot of you know. It's called an operating risk. In other words, as you borrow money and borrow more money, your interest rates and your debt service will go up. It's a financial risk. It's a risk to your ownership. If you borrow money, that means you have to pay it back. If you default, the shareholders, the equity position holders, will lose value of the company. It's called financial leverage. The higher the debt, the greater your company is leveraged. In other words, less money to use to invest and grow or try new areas of investment. That financial or debt leverage will reduce that because it's taking more money out of your business. Now, granted, one positive thing about debt is you get a tax shield, as we've discussed in our WACC calculation. You borrow money, you get a portion of that taken off of your tax return and returned to you on your income taxes because it's a tax shield. But when does that tax shield prove risky? Is to naturally if you borrow more money or interest rates are going up. But a positive thing of borrowing money is tax shield. But operating risk, financial leverage are all negative aspects of borrowing money. So what are the financial choices that a company has when they decide to borrow money and not be all equity financed? Well, one is what we've discussed, the trade-off theory, where debt levels are managed so you can get the tax break. So you're borrowing money to get tax shields and tax deductions or income tax reductions on your company. So it's called a trade-off theory. Yeah, I'm going to borrow money, but I'm also going to get a tax break. Another is, it's kind of funny, but it's called the pecking order theory, that firms prefer to issue debt rather than equity if internal finance is insufficient. In other words, if we have to buy an asset and we can't buy that asset by the profits that we've made over the prior years, and we have that cash flow, and we can't buy that asset by accounts payable or short-term borrowing like 30-day financing, which would be nuts for large amounts of assets. So what's result is we have to go outside the business. Remember, debt is outside the company. You go to a bank, you go to issue a bond. So you go outside the company to borrow the money at a higher interest rate because you have no other ways of generating that capital internally. There's no profits to take, and there's no way of financing large purchases of assets through accounts payable. So it's called the pecking order theory. Another is the cost arising, it's financial distress. Costs arising from bankruptcy or distorted business decisions before bankruptcy. One of the biggest failures in American business is you keep borrowing money and eventually you're going to run out of your credit. You're going to you're generating all your cash flow in your company, not for growth, but to pay off the debt. Welcome to Radio Shack. Welcome to a lot of businesses that you have read about over the last few years that have gone bankruptcy because they keep borrowing money to finance. They're not generating cash flow. That's what bankruptcy is. And another is called financial slack. Ready to access cash or debt financing. In other words, let's say, let's use a personal example. Let's say you want to buy a car, all right? Well, you have two ways of financing a car. You can pay cash for it, which most of us don't have $20, $30, $40, $50,000 of cash on hand to buy a car, or why spend that 20, 30, 40, or 50,000 because it's already invested and earning a nice return. Why don't I just leave that alone and borrow the money? But then again, if you borrow the money, then into the next future, 3 years, 4 years, 5 years, even 6 years, you got to take money from your income potential and income growth and pay off that debt. So it's kind of damned if you do, damned if you don't. What is your benefit from either way? It's called financial slack. Do you want to use cash or do you want to use the borrowing of money? These are key choices and key definitions of debt financing for all corporations. At the beginning of class, we talked about three main principles of finance. The investment principle, what you're going to invest in to grow the business. the financing principle, how you're going to finance, what is going to be the mix of debt and equity that you're going to use to finance that asset, and also the dividend or the return principle of finance. How do you get your money back to your investors? Well, naturally in debt, you're paying off principal and interest. But to shareholders, how do you pay back shareholders? Well, you hopefully the stock grows with the performance of the company in relationship to the market value. But more importantly, it's dividends, the paying of dividends. You want to keep investors happy. You want to pay a quarterly dividend. One of the things I'm having you do this in our studies is determine the amount of dividends your company has paid over the last 8 weeks or so of our course. Find out what dividend payments have the company made, because even though the stock price might be falling in these bad stock market conditions we're in, as long as I'm getting some cash flow and dividends, maybe that I'm willing to get through this downturn in the stock price, because I know I'm getting a reward for my money in the form of cash flow, dividends. And there's a variety of ways to get a dividend to an investor. And this is one of the key parts of chapter 17. There's a cash dividend. You payments of cash by the firm to the shareholders. Just the other day, I got a $2.30 dividend check from American Corporation. Wow, I'm rolling in it. I could go out and maybe get a slice of pizza. Big deal. You know what? I can't even get a slice of pizza for $2.30. But a cash dividend is actually cash payments made to the investor. And those cash payments are made on what is called the ex-dividend date. That's the date that the company declares a stock to be paid on a quarterly, semi-annually, or even yearly basis. And if you're a stockholder on that date, you get the dividend. The record date is that date that the company records who owns the stock. Besides a cash dividend, there are stock dividends. Many of you might participate in a stock ownership plan with your companies you work for. Instead of giving you dividend payments in cash, they say, well, if you buy stock in your company, we'll give you a stock dividend every quarter. You'll own a little bit more of the business every quarter or year. So distribution of wealth of the company, not in cash, as additional equity position. Another is called stock splits. Apple does this every now and then. Amazon is about ready to do it in a few weeks at the beginning of June to split the stock. If the stock price gets too high in the market, a lot of people can't afford to pay $2,500 for Amazon stock, even though that stock is down about 25% in the last month. So what do companies do to make the stock more interesting to investors? They split it. For example, let's say I own one share of stock in a company that currently has a value of $100 a share. If the company decides to do a 2-for-1 stock split, on the date of that stock split, I will now own 2 shares of that stock in that company, and the stock price will go from $100 to $50. So instead of owning 1 share at $100, when the stock split occurs, I now own 2 shares at $50. Now, it's the same value, but here's the thing. I now own an additional share, 2-for-1, additional stock, and hopefully, because at the $50 stock price now in the market, more people will be buying the stock, forcing the stock price up over time. Thus, I now own 1 more additional share and at a growing dollar value. Stock splits are very popular, especially with high-tech companies who want to maintain their cash balances so they can invest in new markets and new products. So how do they attract investors? They split the stock. Another is very popular, is called a stock repurchase plan, where a company can go to you and say, hey, Rick, you own 1 share of stock in our company at $100. How would you like a check for $130 and we'll buy that stock back from you? Well, I've been waiting for the stock to go up over time, and now in one fell swoop, I can get $30 extra cash for that stock by selling it back to the company. It's called a stock repurchase. Many times on the balance sheet, this transaction is called treasury stock. When the company goes into the market and buys back stock from the investors get a quick gain, but they no longer own the stock. The company buys back that stock. One other method of stock repurchase is also it reduces the amount of shares available to investors in the market because the company now has bought them back. Thus, probably the stock price will go up by the law of supply and demand. Stock dividend, stock splits, stock repurchase, great ways of getting return to investors without spending any money. So as we wrap up this weekend of video of week number 7, a couple things to note. You have assignment 4 due Sunday evening, but if you let me know, you can grant an extension. That assignment is in the assignment section of your Blackboard. There it is right there, and a spreadsheet template is provided for you to do all your work on. Also, assignment 3 grades are posted. The solutions are right here, and your work is returned to you in your grade center. The final examination will be posted to this same file folder tomorrow evening around the 6 o'clock hour. It will cover chapters 21. I can't remember off the top of my head, but I'll put that down in writing when I got it right here. Here we go. Let's get that. There you go. Sorry, my computer spiked a little bit. So again, final examination will be posted on Sunday evening. We'll cover chapters 8, 9, 10, 11, 12, 16, 17, 18, and 19, the second half of our course. And you've had, we've gone over every one of these issues. You've done it in some assignments. So there should be no mysteries in what you have to do. Also remember, you'll be doing your final portfolio evaluation of the value of your portfolio and also the value of the 3 market indexes and their change. That will be done on Friday, May 27th as part of your examination to update your portfolio. If all that being done, then we will conclude the course with please feel free to, I really appreciate you doing your course evaluations, and those are located in the course announcements. There's this link here. You click on that link and it'll take you about 5 minutes to do the course evaluation. I would appreciate that as you wrap up the course over the next week. I'll give you additional reminders in my emails to you, but please, if you could, it's very important to me, and also you'll get your grades sooner on Blackboard by June 2nd. So that's as we conclude, and with the final examination posting video of tomorrow evening on Sunday, I also will have my course lecture for week number 8, talking about chapters 18 and 19 and introducing the final examination. So we have 2 videos left, the week 8 lecture video, which will be posted Sunday evening, and an update video to the course on the end of next week to conclude our studies here in business finance. So thank you, everybody. You know where to find me if you have questions. Do your evaluation, finish up your assignment 4, and good luck on the examination. And until Sunday, tomorrow, I'll see you then. Bye-bye.